Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
And he lost the whole $600,000 because it wasn't invested the way he thought it was. The company wasn't as solid as what he thought.
Boy, that is tragic. And I've heard stories like that before too. It's so important to understand your risk tolerance, to understand what you're in, and to be able to do that assessment, right? Your risk versus your return. I'm Daniel Agemy.
And I'm Andrew Agemy. You listen to Financial Strategies with Andrew and Daniel Agemy. This father-son team coming to you to talk about this week's topic is investing your way. What is your way? Well, that's the question, right? And do you even know what your way is? Well, you need to know what your way is, right? You need to know so that you can make sure that your money is set up congruently with how you want it to be set up.
Yeah, absolutely. AAA, people are getting pushed onto certain ways of investing without, number one, knowing all the different types of investments that there are, and number two, really considering where they are. So when we talk to most investors, they think that there's the market. Even some of our clients who have been with us investing in neither of these two options sometimes still get confused. There's the market, there's the stock market, that's a roller coaster, and there's the bank that maybe you'll make something or maybe you won't make something. And there's not really anything in between, right?
No.
And people get pushed to one aspect or the other, right? And that's what we're doing this show, investing your way. And we want people to help figure out what your way is, what's going to make you comfortable, what's going to support the lifestyle that you want to have. It's all about you.
Exactly. And that's the whole point. You're exactly right, Daniel. People think it's one extreme or the other, but there's not. There's a lot of things in between that people don't know about. And that's one of the points that we're going to be coming to later on, is talking about the stock market. But there's different kinds of markets. There's the real estate market, the used car market, the stock market, the fixed income market. There's a lot of different markets. What's a market? It's a place where things are for sale. And what's something for sale for? Well, it's for sale for what somebody is willing to pay for it, right? And all those different kinds of investments, all those different kinds of things that are being sold act differently, and the pricing acts differently. And you have to make sure that that things are working your way. You go to a market where you're buying. I remember when I was 13 years old, I went to Mexico. And with my sister and my mother, and we went on in Mexico, and it was all a market, right? Where we're walking around and people are trying to get us to buy stuff and everything like that. And the key is being able to understand what you're buying and what it's going to do for you in any kind of market. But when we're talking about your retirement monies, that's especially important that you know what's going on and that you're congruent with it.
Yeah, absolutely. So how would you go through a few of these self-assessment questions to help people know what their way is? Because like I said earlier, a lot of people are pushed by the marketing machine, whether that be BlackRock or some of these other big Vanguard, right? Some of these things that say this is the only way to invest. And a lot of times, I will hear people say things like the S&P pays 8 to 10% a year. And folks, the S&P does not pay 8 to 10% a year. If it pays anything, it pays about 1 to 1.5% a year.
Right.
The rest is appreciation that there's no promise of. Some years it's negative and some years it's positive. But it does not pay 8 to 10%. That's a lie. If someone told you that or you think that is not the truth, it does not pay. Now, what it has done, it has averaged 8 to 10% a year. Okay. 9.5 over 150 years, but it's had decades where it's had no earnings.
Right.
It's been flat. Right. And it's had times where it's done really well. So it's tricky to say it pays 8 to 10% because it does not pay. That's a marketing machine that's telling you that through Vanguard, BlackRock, State Street, some of these other big firms. Because they get paid if you stay in the S&P or that you get stayed in these equity funds that they have. The difficulty comes in if that's not where you feel comfortable, and because you say, I don't want to be social investing. Like, as long as everyone believes it does 8 to 10%, it will keep doing 8 to 10% because everyone will put the money in. But as soon as people say, wait a second, this is just depending on other people putting their money into the same 500 stocks. Andrew, you and I could start our own club. It will be invest in 40 stocks. And we'll get everyone to invest in those 40 stocks in the world. And what do you think will happen to those 40 stocks? As long as people believe it, they'll go up. And that's what's going on with 500 stocks in the US right now.
Right.
And so if that's right for you, maybe. If that's not right for you, maybe. But hopefully these assessments can help us determine what type of investor people are.
Right. Exactly, Daniel. The thing is, it's not pain. I just want to reiterate what you said and make sure the audience gets this. It's appreciating. The stock is going up in price from $10 a share, $11 a share, $12 a share. But the problem with that is it can depreciate and go from 11 to 10 to 9 to 8 to 7. And it doesn't pay. The dividend is what pays. So good point, Danny. Excellent point. And it's important to understand how you want to receive your lumps, so to speak, right? How you want, what you want to do with your money to be able to do. And what you want is dependent upon a lot of things. And we have this assessment we're going to go into in a moment or so. And if you're 20 or 30 years old, what your way is generally speaking a much different way than a 60-year-old or 70-year-old from that standpoint. So we want to make sure that you're here and be able to retire and stay retired. You're listening to Financial Strategies with Andrew and Daniel Agemy, this father-son team, coming to you today with Investing Your Way. And we want to be able to help you to know what you don't know. And so as a result of that, we have some things that we want to give to you today. Right now, we want to give you a paper called The 10 Warning Signs of Working with the Wrong Financial Advisor, right? If you got how many bad advices does it take to be able to ruin somebody's portfolio? One. Right? So if you got the wrong one, you can pay a lot of fees and you can actually go lose money or be not anywhere near you want to be. They need to be able to understand your rate. But this paper, 10 Warning Signs of Working with the Wrong Financial Advisors, for yours for free by calling us at 800-725-7616. 800-725-7616. Call now for that. You listen to Financial Strategies. Today's topic is Investing Your Way. Daniel, as we delve into this self-assessment questions that people can ask to be able to understand themselves better, right, for what their definition is of how they want to invest, right? Hit it.
Correct. Well, our first one is, what is your primary goal for putting your money in the market or investing your money? There's more than the market, so there's other things, but typically people think there's just the market. So what is the primary goal? Are you investing the money to generate steady income so that you can support your lifestyle when you stop receiving a paycheck? Right. Are you doing it to grow your wealth over time? Are you investing your money in order to make quick profits from market movements? Or are you just trying to invest it so you earn something because you have a purchase you want to buy? You have a purchase, a home, something like that. You'll need the money for in a few months or a year, right?
Right.
So it's which of those, what is the reason? What's the purpose behind the reason you're putting this money to work for you?
Yeah. Those are very important things to be able to look at and to be able to understand. The goal of your money is huge, right? And when you're talking about the goal, and like you mentioned that one day, are you interested in steady income that you can be able to have when your paycheck stops paying you, that your investments can pay you, right? And that is a very important thing. And there's two numbers that could be, right? There's the number that you need in retirement to be able to sit on the couch watching the news all day. And then there's the number that you want so that you can go out and about and travel or take care of the grandkids or build the different relationships that you have in your life. So there's two different things. And many times people don't understand the difference between those two. But the goal of your money is a huge point. The second one is, how often do you check your investment performance? Daniel, I know a lot of people that have said to me during 2008 and the financial crisis, when the market dropped, even COVID, right, that they would just get their statement and throw it in a drawer and not look at it, right? So different people have different ways of looking at the investments. I know some people say, hey, we want to see like weekly what's going on with our money. And I said to them, why? The clients of ours, right? I said, why? Because it's not changing weekly. It's the steady Eddie approach. And that's why we produce these things maybe quarterly, maybe every 6 months or whatever, in a whole portfolio fashion that you can see everything in one easy form, summary form. And then once they understood how their investments were going to work, they were happy with that. And they didn't need to see it every day. So some different folks have different things, right?
So AAA, that's why this assessment is so important, because these are questions people should be answering. And we might cheat a little bit and give a couple of these answers here because it depends what type of investor you are. So for example, the story at the beginning of the show, we were talking about somebody who lost $600,000, their entire portfolio. And it was because they had all their money in one company, and that one company was a fraud. They were cooking the books.
Right.
And that can happen with equities, right? That you can lose all your money, and people forget that. And that's why index investing has become so popular, is because they say, well, you can't lose all your money if you're in 500 stocks, right?
Well, and Daniel, the thing I want to point out about that is that was his own company stock that he was in. He lost $600,000 in the company stock of his company in his 401k. It was much like the Enron deal.
Right.
But that's a great example of, you have to be careful.
So when you have a concentrated basket like that, and you have all your money in one company, or you are trying to make quick profits on market moves, how often you check and watch your investments, check what's going on with that company, check what's going on with the price movement or the performance of your portfolio changes. You need to do it more if you're concentrated in one company, or if you're trying to get a quick $2 move and then sell out of it real quick, right? That changes compared to if you are one of these other types of investors, an income investor. You're going to be collecting your income. So go and spend your income on your vacation, relax a little, go on a cruise, take a flight somewhere you want to go, have a wonderful dinner, and let your income pay you to do that. You don't need to check the portfolio. So it depends where you are. That guy with the 600 probably should have been watching the financial reporting on his company a little bit more, because he would have realized something was off, right? So it depends what type of investor you are, how often you need to be checking.
Well, you're absolutely right. But one of the issues is that people don't, with their company, they think their company is solid, so they don't need to check it, right? But there's one rogue accountant that does it, or maybe in this case, there was more than one rogue accountant. But how often are you checking your performance? That's a key thing to take a look at, right? And so when we're talking about this, we're going to have to go to break here, but you're listening to Financial Strategies with Andrew and Daniel Agemy. And, Investing Your Way is the title of today's show that we're trying to help you figure out what is your way. And we have a book that we'd love to give you called Return on Principle by our friend David Scranton. And this book here will be able to help you to be able to understand more things about retirement, about investing in the broad sense, easy read book that will be able to help you to be able to make progress and understand what is your way. That's the key. You need to understand what is your way. You can have the book for free by calling us at 800-725-7616. 800-725-7616 for your free copy. The next 5 first-time callers, 800-725-7616. Call now.
Important financial question. Are you feeling confident that you have enough money saved to enjoy a stress-free retirement?
Honestly, I'm not sure.
That's where Retirement Income Sources investment advisory arm comes in. We exist to help you invest your money smartly.
I'm struggling to accept my retirement without a steady paycheck. So can you help me invest into a profitable revenue plan?
Absolutely. We have top advisors nationwide who have a fiduciary obligation to you, helping you generate retirement income.
This is Financial Strategies with Andrew and Daniel Agemy.
Hey, Daniel, I'm thinking of our friend Jimmy, our client Jimmy. And before Jimmy came to be our client, and when I was going through and talking to him about what we do and how we help people to retire and stay retired and have more than enough income that they need for the rest of their life. And when I was explaining that stuff to him, he was like, I knew there was somebody that could do this. I knew it. I've been having Edward Jones talk to me and Smith Barney and all these other different people. But nobody was telling me what I wanted. I knew there was a way to get more than enough income that, from my investments to be able to relive the rest of my life the way that I wanted to, but I didn't know how, and I didn't know who had it. And then I heard about you guys, and I'm calling you and did that. So that was just an amazing story and an example of how he knew how he wanted to invest his way, but nobody could help him. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about investing your way. And AAA, I resonate with that story because I talk to people often who say that same type of thing. It's amazing how many people out there intuitively know the way that they want to invest, but when they talk to professionals, right, they tell them that way isn't a way to invest, and they know they can somehow. They just haven't found the right person to help them invest their way.
Right. And that's why I say that we're a needle in a haystack, because there are not very many people that do this kind of thing. And why is that? Because Wall Street is predominantly across the board. Wall Street makes money when the market goes up, when the market goes down, when the market goes sideways. Unfortunately, those people that invest in Wall Street or invest in the stock market only make money, generally speaking, or the big money when the market goes up. And so Wall Street wants to have as much as people's money in the market for as long as possible, whereas they don't make as much money on these types of things that we're talking about that can provide income for the rest of your life. And so therefore they don't want to tout that. Therefore the media doesn't tout that. Therefore people don't know what they don't know. And that's why we exist, so that we can help people know what they don't know, right? And we're going down this self-assessment questions on what is your way? How to invest your way? And we've already talked about what is your primary goal when putting money in the market. You have to ask yourself, and how often do you check your investment performance? Next one on the list is, what's your typical holding period for an investment? Well, several different things, right? You could be one that just buys stuff and holds stuff. You could be one that you're 1 or 3 years and then you're out of it. You could be day trading, or some time frame of trading, days or weeks or months. Then you pop out of it again. That's what a lot of the talking heads on TV, so to speak, are geared toward, right? They're geared toward how you can make money in the day or the 2 days or the week, right, Daniel?
Which is more of a speculative way of investing. You need to have a lot of input. You need to pay a lot of attention, and there's no promise of return.
Right.
Where
it's not for the do it. These are do-it-yourselfers. Most people with their money, right in the 70s, ERISA came into play in the mid 70s. IRAs came on the scene, and then through the rest of the 70s, especially into the 80s, and even today, companies are more and more getting rid of their pension programs and installing 401k programs where they're taking the risk off of the company and putting it, the risk of retirement on the individuals. And so now the individuals are having to do stuff themselves, but a lot of them don't know how to. And it's truly an egregious thing. Now, that's exactly why financial advisory companies such as ours has grown so much over the past decades, because there's more of a need today than there were for, our parents back in the 60s and 50s and 40s and things, because they had pensions back then.
Right.
And even today, people with pensions, they still have 401ks and they need to be able to do stuff. But, you could do it yourself, but it's not as easy today as it used to be. Just like, I used to work on cars myself, on my own cars. Now I don't do it anymore because they're not easy anymore like that. And so same thing with investments, are not as easy. And that's why you need to be able to know what is your way. So you need to know what kind of help to get. And that's where it comes into play. What kind of holding period? And you can say, well, I don't know. My financial advisor does that for me. Well, that kind of tells us. So you don't want to do it yourself, right? You want somebody to help you with it.
Right. And with those pensions, the old way of investing, you got an institutional money manager, someone that knew how to manage huge piles of capital, and they were very good at it, and that's all they did. And now you get like a fund advisor or a financial advisor who has seen the name of that mutual fund before, and they'll suggest a mutual fund to you compared to somebody that's in looking at balance sheets, right? And so the quality of investments has changed tremendously from when you had the pension, you had an institutional or multiple institutional managers managing that money to a plan where somebody picks investments, and then you as the employee, you're very good at your job. You may or may not be good at picking investments. It's all on you to pick the right fund. You can't even pick stocks typically in 401ks. You got to pick the right fund, and it increases the risk and it lowers the certainty of your returns when people are in these funds instead of individual investments that someone who's a professional picked.
Exactly. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is investing your way. And we're glad that to be able to come to you today, this father and son team, trying to help you to know what you don't know. We have a paper that we'd love to put in your hand. And how many financial advisors does it take to ruin somebody's retirement? One. So it's important for you to know if you're with the wrong advisor. So this paper today is 10 warning signs as if you're working with the wrong financial advisor. So we'd love to put this in your hand for free, no obligation. Call us at 800-725-7616, 800-725-7616. Ask for it by name, the paper called Wrong Advisor. Okay, you'll love it. You listen to in Financial Strategies with Andrew Agemy, investing your way. Daniel, the next one, we still got a bunch to go here, man. We need to get moving. How do you react to market volatility? Do I stay calm? Do you stick in it for the long term? Do you get concerned and try to avoid making rash decisions? Or do you see it as an opportunity to make quick trades? So all three are valid ways of looking at it if it's your way. That's the question. Which one of these are your way? And one of the things in regard to market volatility is how somebody handled market volatility when they were 40 years old or 50 years old back in 2008 when the market dropped 60% is one thing. But if the market were to drop 60% today, how would that feel now that you're 60 or 70 years old? Big difference. So there's one way you used to be, but there's another way that you are now. You have to you have to get a hold of your true self, today's self, to be able to understand these questions. So many times I'll say to people, are you conservative or aggressive investor? And many times they'll say, well, I'm conservative from what I used to be. Or they'll say, I'm not as aggressive as I used to be, right? So that's a key aspect.
And the other one with this, how do you react to market volatility, would be, you just said people change and the risk levels change, but also what changes is the amount of capital they have. So if you had a 50% drawdown and you had $10,000 in your portfolio, you lost $5,000. That's not near 5,000. How emotional is that to you? But if you have $1 million and it goes down 50% and you just lost $500,000, that's a lot different than right? That's another emotional thing. So as you accumulate wealth, these things changes. Not only do we change as we get older, but it changes when you're talking about the size of the pile that you've accumulated.
Good point, Daniel. I mean, what was obvious to me, I didn't say, but I needed to say that to our listening audience, right? But that's one of the reasons, right? Because when it comes down and you keep putting your money in, that's good, but it doesn't do as much good today as it did 20 years ago because you have so much more money in there and it doesn't offset it as much. So good point. Let's go on to the next one. What's more important to you in an investment? A, consistent dividend payments or all the money that you can have to live the rest of your life the way that you want. B, steady growth and value over time in the asset value going up. C, potential of rapid price appreciation. So quick gains, right? Kind of like the hare, right? In the tortoise and the hare. Do you want to, jump up fast? How many times on the highway do you see a car, they pass you, and then, a while later, just going down the road, they pass you again? So what happened? And then they pass you again, and then they pass you again, right? It's like, what in the world? I said, that's the tortoise and the hare story, right?
Yeah, absolutely. And I think on that C, the potential, right? So often people will say things like, we need to make more money. We need to take on more risk. And they forget that potential part, right? Right. Potential for rapid price appreciation. When you're investing, as we call speculation, you're investing for those rapid gains, or you're investing and there's no promise of return. It's all potential. when you're investing by contract, or you have a dividend, for example, that's promised to you, or even if it's not promised to you, like on a preferred stock, if it's just voted on every month, but the company wants to keep their dividend, that's a lot more. That's less going for hope, right?
Right.
And so there's that whole spectrum from a bond where it's a contract that they have to pay you, all the way out to you're jumping into a stock because you're hoping that you're going to get 2 points of appreciation and get out of it before other people do.
Right. And risk versus reward. The risk has to be worth the reward. Then why risk it? Right? You go to a casino and they say, hey, lay down a $100 bill here, and you might be able to make $10, $20 on that. So you walk away with 110, 120, maybe even 130, right? But you could lose 50 and walk away with 50, or you could lose the whole thing. Is that risk worth the reward? Well, for most people in retirement with their retirement savings, they say no. Now, for a little piece of your portfolio, maybe that's okay, right? But that's the key is what's the risk versus the reward? Is the risk versus worth the reward? Well, we still have some more to go here, but I see it's time for us to take a break. And before we go to break, we'd love to give you this book that we have today called Return on Principle by our friend David Scranton, 7 core values to help protect your money in good times and bad. I love to put this in your hand, help educate you. Easy read book, Amazon bestseller. Love to put it in your hand. Call us 800-725-7616 for your free, no obligation book. If you're a client, we'd love to put this in your hand, help educate you further. Otherwise, if you're a radio listener, for the first 5 first-time callers, 800-725-7616. Call now.
Time for some tough questions for these financial advisors. What makes Retirement Income Source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love.
We gotta talk to these guys. We're done here.
This is Financial Strategy with Andrew and Daniel Agemy.
AAA, it's fascinating how everyone thinks differently about retirement. And I was talking to a CPA the other day, and we were talking about retirement. And the question came up, is there a retirement plan? Is there a retirement plan? Well, a retirement plan, I mean, simple math, right? If you have X amount of money and you're going to collect a certain amount of money, you know what the retirement is, or were you asking for more? And he said, well, how much money? So let's say $7 million, right? The person wants to retire on $7 million. And then he did his calculation that, okay, that means you can have $200,000. And the other person said, that
a year.
I hope we live longer than that. I hope we live longer than that. And he said, well, that's based on life expectancy. That's based on life. So, right? But what he did was he took the amount of money that they accumulated, he divided it by their life expectancy and came up with how much money you could spend. And I said, I would have done that very differently. What I would have done is I would have said, if you had $7 to $10 million, you would easily collect 5 to 6% interest on that, which means you're getting paid somewhere between $400,000 and $600,000 a year for as long as you live. Everybody thinks about it differently. I'm Daniel Agemy.
And I'm Andrew Agemy, and you're listening to Financial Strategies. Andrew Daniel Agemy, this father-son team, coming to you today talking about investing your way, because people don't know what people don't know. People don't know oftentimes what is their way of investing. And that's why we're trying to help you define that today, so that you can be able to make progress and be able to retire and stay retired. Danielle, the wonderful examples you gave there so many times. The greatest generation was a generation who said, don't spend your principal, spend your interest. And the baby boomers, with being enamored with the stock market, started in 1980 when the stock market, the Dow was 700, and then by 2000 was 11,700. Now it's pushing 40,000 and whatnot. Right, they're enamored with the stock market, and they forgot about that whole concept of don't spend principal, spend the interest, spend the dividend. And that's the example you're giving it. The CPA was saying, okay, spend the principal, and not a wise choice at all to spend principal, because once you spend principal, it's gone. Right.
But the person whose money it was, she was saying, I hope we live longer than that.
Right. Right. Well, that's the point. That reminds me of one of our newest clients she went to her old advisor and said, how long will I be able to live on my money? He said, till you're somewhere between 91 and 94 years old. And she said, I don't want to do that. I want to live longer than that. I don't want to run out of money at that. And then when she came in and we revamped her portfolio and we showed her how she's going to have all the money that she needs to live off of dividends and interest for the rest of her life. And if she needs to spend her principal, it will be to keep her in her home instead of going into a nursing home. Who wants to run out of money? Nobody. That's the retiree's greatest fear. That CPA is not helping any retirees from that standpoint, right? That's exactly what retirees don't want to do. And that is what we're about, is making sure that retirees don't spend their principal, spend their interest dividends. And that was that one assessment, right? What's more important to you? Consistent dividends and payments? Enough money to be more than enough money to live the rest of your life, or income to live the rest of your life every year? Because it doesn't matter what your assets are. What matters is what they're going to pay you. Right. So I love giving this example, Dan. I know you're tired of it, right? But when you go to retire, you need to be able to eat. And now if you buy roosters, okay, well, you'll be able to eat, but you have to kill a rooster. And depending how long you live and depending what happens to the roosters and everything like that, you could run out of roosters. But if you buy chickens and you only eat the eggs, you'll be able to eat the rest of your life. And then if you have to eat the chickens at the end, right, well, that's another thing. But hopefully we don't even get to that point.
It gives you a margin for error. It gives you a lot more confidence because you're not spending down your assets. Our subconscious is so powerful. And so I guess maybe part of the whole thing, spending down your assets, is subconsciously how much money you have, and you'll kind of just die automatically. Your subconscious will take care of that for you and make sure you die before you run out of money. But that's not what we want. We want to live long lives, not that our bodies tell us we have to die because we're almost out of money, or all the stress and panic that it brings as we're getting close to that, right? You want to be, if they discover something, some type of medical miracle, and you can live to be 120 and you have a wonderful life and you want to live to 120, your assets can keep giving you that lifestyle without having to worry.
Right. So that's that's one of the key questions on this analytics, this assessment that we're doing. What's more important to you in an investment? Consistent dividends, steady growth in value over time, or potential for rapid price appreciation? And that goes back to the first one, which was, what's your primary goal? Too. That depends what your goal is. So let's move on to the next one. But before we do, I want to let you know that we're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is investing your way. This father-son team coming to you because people don't know what people don't know. And one thing that people don't know is how much do they need to retire, right? So we have a paper today that we'd love to put in your hand. It will help you be able to analyze what you need, what you want to retire. We recommend this easy read brochure that will educate you even further. You can have that for free by calling us, no obligation, 800-725-7616, 800-725-7616, for how much do I need to retire? Call them now. All right, Daniel, let's move on. How much research do you typically do before making an investment? A, extensive research into company fundamentals and financials. B, some research, but I also rely on expert opinions. C, I focus mainly on price charts and market sentiment. Now, Daniel, I think there should be a D. I depend upon my financial advisor.
Yeah.
Right.
Yeah.
Right. That's not in there. But what's important to know and to look at here when we're looking at this one is, how much do you want to do? How much research do you want to do? Some people, what we want is our clients to be able to be out there enjoying their retirement and not worrying about their money. We like to act as the CFO for our clients, they're the CEOs. We want to educate them to make smart decisions, educate them on what's happening with their investments, and not make them get into the nitty gritty. We like to do the macro, that we have them do the macro management, the high level management, and we do the micro management, right? And there's a lot involved with micromanagement.
I think if people have an advisor, these are good questions for them to ask their advisor as well, is how the advisors are picking the investments. Are they diving into financial reports, or are they listening to financial news, or are they getting it off of hot tips and social media? And hopefully their advisor is going to be honest with them and let them know how they're building out the portfolio, or they don't know because they sub it out to somebody else and they don't know how that person's picking for you. It's important to know all the layers, because you're hiring somebody. Are they hiring somebody? Are they hiring somebody? Who's actually the one picking what is going into your account if you have an advisor?
Yeah, Daniel, I would not hire somebody to find me a mechanic to work on my car. But yet that's what a lot of people are doing with their financial advisors. They're paying somebody to find them somebody to invest their money, or find somebody to find them or they sign somebody, right? Depending how that goes, right? Yeah. And that does not make any sense to me. I mean, you know what happens? You know what's added for every layer, Daniel? Right? Fee.
A fee. For a fee.
For a fee, right? And what do fees do to somebody's investments? Lower them. Lower the investments because they take out of them, right? That's one of the 8 sources of estate leakage that we talk about when we talk about estate planning in our estate planning workshops, is fees. Now, I'm not against fees. I'm against egregious and too high fees. And it's very interesting. And I love to say how we are running other people on the road that our office in Guilford is on, are charging twice and sometimes 2/3, three times more what it is that we are charging from that standpoint. So, or their clients are paying that. So all in. But let's move on, Daniel. How much research? Oh, that's one we just did, right? No. How much research do you?
I think I skipped ahead, maybe.
Nope. That's one I just know. What's your primary source of investment ideas? There we go. Financial statements and annual reports, financial news and analyst reports, social media, online forums, or hot tips. So what's your primary source of investment ideas? This is a great question to be able to ask yourself. Again, if you had a CFO that's going to be your primary source of educating you, that you can depend upon, that knows the business in and out, has been in it for decades, specializes in helping you retire and stay retired, then you're going to be in a great position to be able to not have to worry about what's happening otherwise. You do see something on social media or forums or stock tips or any of those things, and you run that by your CFO, and they'll be able to give you a clear perspective, especially if you're a true fiduciary working for your and on your behalf only, not on the behalf of stockholders of the large name company that they're part of. So,
yeah, that's important. If people don't know what you're talking about when you're saying CFO, you need somebody to be the CFO, the chief financial officer of the family's portfolio, of the investor's portfolio. And you may be the CFO, you may not have a CFO, you may sub it out to a CFO, but everybody needs a CFO. And if you don't have one, you need to consider who are you going to hire to be that personal CFO of the financial portfolio to bring you the ideas. You're a smart person. You're going to be the one who is the CEO making the decisions, but you need somebody to bring you those ideas and suggestions so that you don't have to spend all your time being the CFO yourself.
Right. And somebody that can be the proverbial guardrails on the mountain of the retirement to keep you on the mountain, not letting you make a dumb decision or a mistake, right? It's like you don't want to go to you wanted a doctor that's going to give you the straight news so that they can, you don't get cancer or don't contract something or whatnot. You don't want a doctor that's going to be nice. And then by being nice, they're actually going to let you die early because they're not telling you something that you need to know. So same thing when it comes to the financial realm. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy, this father-son team coming to you, talking today about investing your way, trying to help you define and describe what your way looks like and giving you some feedback, some education to be able to see that and understand that. We've got a book for you. We want to continue to educate you before we go to break. It's called Return on Principle, by David Scranton. Great book to be able to help you learn and the principles of investing, principles of retirement planning, so that you can be able to retire and stay retired. We'd love to put this in your hand for free for the next 5 first-time callers at 800-725-7616. If you're a client of ours, please call us. We'd love to help educate you further from that standpoint. But if you're a radio show listener, first 5 first-time callers, no obligation, 800-725-7616. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement. It's a little more income stability.
I'm in.
That's 2 out of 3.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
AAA, there's 2 people walking down the street. They're going to get lunch. There is a professor and there's a money manager. And they're talking about arguing about different investment philosophies. One has real experience and the other one is a professor. So he's got lots of book knowledge. And there's a $100 bill laying there on the ground. And the money manager says to the professor, "Hey, there's $100. Why don't you grab that $100? And the professor says, "No. If that was a real $100 bill, somebody would have already picked it up and there wouldn't be an opportunity there." So the money manager grabs it, picks it up, puts it in his pocket. They have a wonderful lunch. And at the end of the meal, the professor says to the money manager, "Why don't you pay for the meal with that $100 you found?" And the money manager says, "What $100? I'm Daniel Agemy."
And I'm Andrew Agemy. You listen to Financial Strategy with Andrew and Daniel Agemy. Today's topic is investing your way. Trying to be able to help people know what they don't know and be able to help you understand how to invest your way. What is your way, right? You have to know what is your way. So we've been going down a self-assessment questions and talking about these there's 10 of them. And that's what we're talking about. So Daniel, I love that joke. I love that situation, right? Because the professor, that economic professor, says that there are no deals out there, right? Generally speaking, but the efficient market theory says that the market is efficient and there are no deals. And that's simply not true, right? Because there are deals. You just have to know where you look for them. And as one radio show listener called up and they said, I like Daniel. I like the way that Daniel does the treasure hunt. And that's what I do in life. Daniel does treasure hunt too. And that's what it is. Looking for the treasures, right? Looking for the deals that are out there. Okay. So let's go on down. So how diversified is your portfolio? And that's kind of the idea, right? Today, people don't really diversify their portfolios well. But here's the question. Highly diversified across various asset classes. That's A, right? B, are you somewhat diversified within stocks and bonds? C, are you concentrated in a few high potential opportunities, right? Or like what we had talked about last time was that guy who works for his company, had all his money in his company stock. That was not diversified. That was a bad move, right? So how are you doing this? What type of investor are you? Now, Ecclesiastes 11:1-2 says, "Cast your bread upon the water. After many days it will come back to you, given that under 7 portions, even 8, for you don't know what disaster come upon the land." So God is all about and helping us understand wisdom about diversifying. And unfortunately, Daniel, as you well know, right, when people don't diversify the way today that they used to, right? It used to be so much in stocks, so much in individual bonds, so much in cash, so much in commodities. And today, it's so much in stock mutual funds, so much in international mutual funds, so much in speculative mutual funds, so much in bond mutual funds, so much in Bitcoin mutual funds. So it's all about mutual funds, and those are all correlated, which is not true diversification.
Yeah, 2 things. One is they say there's no free lunch, but if there was a free lunch, it would be diversification, right? Because that's the only way you're getting a free lunch is you're taking on lower risks to get the same returns, or you're taking on the same risk to get higher returns. That's the free lunch, right? If there was such a thing as a free lunch. The other thing is the S&P 500 used to be a diversifier. That was the thought process. It had a certain amount in each sector. And now it's ridiculous because 7 stocks is something like 29% of the S&P. Technology is something like 40%. And if you go to like mining and materials, which have been some of the best inflation hedges, that's what some of the best inflation hedges were, especially in the 70s and 80s with the inflation. It's like 2.5%. It's tiny. It's almost non-existent. So even things that used to be good diversifiers, you're talking real diversification. You're talking individual stocks. You're talking individual bonds. You're talking individual commodities or owning real estate to give you diversification. I'm not even getting crazy. I'm just talking about like trying to get it in the S&P. You can't even do it. But in your funds, you're not even getting diversification. They're supposed to be diversified funds is my whole point.
Right. And one of the things I want to bring out to people is like people, our clients will look at their portfolios and they'll say, why do I have so many positions? And why you have so many positions to our clients, because we're speaking to our clients at the same time, is that good diversification, you need at least 30 positions to be able to have good diversification, and up to 500 positions. More than 500 doesn't do you any good. Below 30 doesn't do you any good. Thus, we have the S&P 500. We have the Dow Jones Industrial averages at 30. And so we're somewhere in between those, plus having uncorrelated investments. So like Daniel like we were talking about, individual stocks or individual bonds or these kinds of things to be able to help from that standpoint. And so, because the whole idea of correlated investments as opposed to uncorrelated is the idea where something's up, something's down. You can sell while it's up and rebalance and buy while it's down so that you can ride it up again. Whereas correlated is like the ocean. It's all the ships on the ocean, right? Doesn't matter if they're big ships, little ships, medium-sized ships. They all go down when the tide goes out, and they all come up when the tide comes up. And that's what most people have today as far as diversification, because most of their stuff is in mutual funds of some type or another, or ETS, which is some kind of market. So it's when the market goes up, they all go up. When the market comes down, they all come down. The question is to what extent? And that's not true or good diversification. So you have to look at that. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is investing your way, trying to help you understand how to do that. And we have a paper that we'd love to give you to be able to help you learn more in regard to this. And what it does when it comes to retirement is how much do you need to retire? And depending upon what you need, what you want for retire is going to be able to help you understand how you should be investing. We'd love to put this in your hands for free, no obligation. Please call us 800-725-7616. For your free copy of How Much Do I Need to Retire? Daniel, we just have a few minutes left here. We've got a couple more questions to go, so let's do this, man. What's your attitude toward risk? Why don't you read off those options there we have on this multiple choice test?
All right. A, I prioritize capital preservation. B, I seek balance between growth and safety. C, I'm willing to take big risks for potential big rewards.
Yeah.
And number 10, AAA.
How would you complete this sentence? The best way to make money in the market is A, to invest in quality companies and hold for a long time. B, to build a diversified portfolio and regularly rebalance. Or C, to buy low and sell high, timing the market's ups and downs. Well, what I say to that is, first of all, which market? The stock market, the fixed income market, the real estate market? Right? But that's a great thing, right, Daniel? Because you can't really time the market. And if you try to, you could turn out much worse than you had ever thought.
Yeah. So do you want to give people the answers if they got A, B, or C, or should we have them call in and get the answer on their A, B's, and C's?
Yeah, I think they should call in and ask and get it.
Okay.
Right?
All right.
Yeah.
So we know what type of investor you are based on your answer. So if you got those and wrote those down, you can call in and we can give you the key to the test.
Yes, that's good. Good. So as we finish up, investing your way, just running down those real quick, the evaluation, how you can know what your way is, looking at and asking, what is your primary goal when putting the money into the market? or, investing your money? B, how often do you check your investment performance? Or number 3, rather, I did 1B3, right? What's your typical holding period for an investment? Number 4, how do you react to market volatility? Number 5, what's more important to you in an investment? Number 6, how much research do you typically do before making an investment? Number 7, what's your primary source of investment ideas? Number 8, how diversified is your portfolio? Number 9, what's your attitude towards risk? And number 10, how would you complete the sentence? The best way to invest my money is. So good analysis, good things. And as we go, the point is you need to understand, if you don't know how to do it, if you don't know what yours is, get somebody to help you. If you have any interest, if you want us to help you, we're glad to be able to answer your questions either offline, or let us know, send them in to us at agemy.com, agemy.com is our website, and you can contact us there, send in your questions, or by calling 800-725-7616, ask your question to the operator, and we'll be glad to be able to air that and tell you what to talk to you about, what your answers are, give your answers there so that others can learn from your questions as well. I want to remind you that all of our shows are, after they air on the radio, and they're on YouTube, as well as any place that you listen to podcasts, as well as our website, agemy.com, agemy.com. Daniel, what am I forgetting as we wind up today?
Well, after taking this assessment question, if you feel that you are not the way your funds are set up, the way your retirement is set up is not in a way that's set up the way you would like it, or that you think it should be based on these questions we went through, then you need to make a change. So that's finding a CFO, that's having a conversation with your advisor, that's having a conversation with yourself if you manage your money, and figuring out how to do better, right? But the point of this was a self-assessment to figure out the way your money should be set up. And as we've had a couple of stories today about investors who knew intuitively that the way that they wanted the money set up to pay them, they knew intuitively that should be available, but couldn't find anyone to help you. There is a way to do it the way you want it. So if that's more aggressive, if that's less aggressive, if that's getting paid income, then find the person who can help you get there. But what you need to do is make a decision. Are you set up right? And is your money the way you want it done to get the outcome that you're looking for?
Exactly. Good stuff. Good info, Daniel. You listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been investing your way. This Father and Son team coming to you because people don't know what people don't know, and we want to educate you to be able to retire and stay retired. We have this book that will continue the education even beyond the airwaves. Return on Principle, 7 core values to help you protect your money in good times and bad, by our friend David Scranton. Love to put this in your hand, easy read book that will help you understand the principles of looking toward the future to be able to not have to run out of money while you're still alive. Well, you can have that book by calling us 800-725-7616 for your free copy. First 5 callers at 800-725-7616. And remember, if you want your retirement to be stress-free, invest for the I more than the G. Until next time.